You've been in the market for a long time. GameStop was a crazy time, Reddit crazy thing. How do you think about that as someone who's basically helping to create products for retail investors?
Well, it's interesting. As you know, we largely are private investors, so we're buying whole companies and whole properties and not really subject to the whims of the stock market. But as a student of markets, obviously I look at it with fascination, and I think it strengthens my conviction that equity markets, daily trading stocks and bonds are perhaps more volatile than the kind of investing we do.
Okay, I think that's a fair comment. But I think one of the things that may come out of this is either it's going to make or break a generation of investors, potentially people further down the road that are going to be putting money to work. When you look at what is happening in the sort of the democratization of equity markets, does that give you hope that actually we're going to be seeing more and more people looking to invest money, looking to be a part of the financial system? Or do you worry that if they see significant losses, it may actually put them off for life?
What I worry about is having a non-professional investors using markets to speculate. History would suggest that doesn't always end terribly well. And they're in the market, competing, if you will, with professional investors who likely have deeper pools of capital and more staying power. When you see folks who are piling on because they see other people making money and they're not really sure what they're doing, that gives me pause. I'd rather place my investments, retirement future with professional investors who are seeking long-term results.
So, Joan, on that, you've been instrumental in growing this retail business for Blackstone. Talk to me about where is it now, where it was, and then what percentage of retail money do you really think can be Blackstone's capital base in the next few years?
So I think the opportunity set is vast. Today, we're managing $100 billion on behalf of individuals, and that's up tenfold from the time Blackstone went public in 2007. But if you look at the pool of assets, it's over $70 trillion, even greater than the institutional pool. But whereas most institutions would have 20, 25% or more in longer term alternative investments, individuals are sub 5%. So if you're planning for your retirement and you're 10, 20, 30, 40 years out, you really don't need 100% of that money invested in daily liquidity stocks and bonds, which over time don't generate the same kind of returns as some private investment categories.
What else would fit in this bucket? What other products are you looking at?
So today, I'd say where advisors are most interested is trying to find safe returns, but good yields. So everywhere around the world, we're seeing very low interest rates. And so how do you generate that kind of income? And we had launched a non-traded REIT, which you mentioned, which has returned 9% to investors since inception, with about a little more than half of that is current income. And we have taken that, applied innovation around a structure to create a credit product. So we're looking at private lending, which over time has been able to generate higher returns than most other fixed income asset classes. And we basically said, okay, what would provide a great experience for investors? So we launched it with fees that are half the average publicly traded BDC, just to give a better experience for investors. So now we have these two power alleys, one in real estate and one in credit.
Hey, Joan, what about like an ESG or impact fund? Everyone's talking about it. Is there actually the will to get into something like that?
So it's interesting. I think it's fascinating. We certainly spend time speaking to investors and advisors about it. To date, though, there hasn't been all that much pickup. So folks say they want to invest in impact funds, but they haven't really put those dollars to work. I think that could change. The dialogue is definitely accelerating, but I think that's going to take time.
Joan, do you think that current investors fully understand the liquidity that they're being offered and are paying for? When we had the market seize up last year, a number of funds got gated or stopped being able to operate properly because they simply just had a duration mismatch. Do you think actually regulators need to look and understand and explain better the liquidity risks that investors are being offered right now? And do you think that could work in your favor?
Well, I do think investors and advisors have to understand the liquidity profile of what they're buying. And therefore, the education piece is a big component of broadening access to these markets. And we spend a lot of time educating advisors on just that. But I will also say, I think you have to be very cautious about which fund managers you're giving your money to. And when we talk about greatly expanding these, I think the guardrails will have to be around which fund managers are professionalized, managing money for the biggest institutions in the world, have long-term demonstrated track records. So it's not so much the structure as what's inside the structure.
So to that point, what is your conversation in DC right now of the Department of Labor maybe changing the rules to let 401ks invest in products like yours? I can only imagine how complicated that will also be.
Well, I think there's an understanding that if you have a government or a corporate pension fund, 20% of those assets are in alternatives. But many of us don't have pension funds, and we're saving for our own retirement. And many of the private asset classes, like the ones that I mentioned, are over time earning, whether it's 2 percentage points, 3 percentage points, annualized greater. And think of how much in terms of retirement savings you're leaving on the table if you're not giving people access to that. So there is absolutely momentum in that direction. I think there's real will to make that happen. But the guardrails that I mentioned earlier, I think will be the same guardrails here. Let's make sure these are highly professional asset managers with long-standing track records where major institutions have vetted them over a long period of time.
Joan, I just want to change the subject completely, but I've only got a minute or so left to ask this question. You are one of the most senior women on Wall Street. Women with children in particular, have been disproportionately affected by COVID, by the pandemic. As the pandemic starts to come to an end, how do we right that wrong?
In terms of how do we right the wrong of women being more adversely impacted?
How do we get more women? How do we get those women back into the labor force? How do we get those women back onto Wall Street? How do we make sure that this effect of COVID, particularly for those that have got to homeschool, that have got to look after their kids, how do we make sure that that we end up with a fair and equitable result?
I think if we've learned anything from COVID, if there is a silver lining, it's that previously, jobs where you thought they couldn't be handled remotely, I think we've learned that they can. Not everyone, of course. There are certain, frontline workers, et cetera, who have to be there in person. But for sure, the large service economy, which is a massive employer, millions of people across the country, I hope coming out of this can be more flexible to meet those demands.